Okay, good day, everybody. Hope you're having a good day. Today we're going to finish off chapter 14, just the last few PowerPoints dealing with the finance and investment cycle. And then we'll move into chapter 15, which talks about the completing of the audit work. So essentially, once the auditors are done auditing the revenue cycle, the purchases cycle, the payroll cycle, finance and investment cycle, and performed most of their other substantive procedures with respect to auditing of bank accounts, accounts receivable, accounts payable, other balance sheet accounts. There are a number of additional procedures that auditors must perform towards the end of the audit process as part of their work. And again, you'll be interacting with auditors who are doing this type of work, so this will help familiarize you with that process. So just to first cover off the last few PowerPoints in chapter 14, these PowerPoints basically deal with fraud. And fraud that we're talking about is fraud at the highest levels. So typically CEOs and CFOs who are conducting fraudulent activities. So if we look at the wording in the PowerPoint first, it says top management personnel who deal with transactions involved in investments, long-term debt, and shareholder equity are not subject to the same kind of control as lower-level management or lower-level employees because, of course, they are at the top of the pyramid, right? They control everything basically that's going on in the corporation. The board of directors, although they do have oversight responsibility on top management, the board of directors typically they are not on site every day, watching what management is doing. Typically, they meet once a quarter, review financial results, question management about what's going on in the company, express any concerns they have. So while they do have that legal responsibility to override, they're not involved in day-to-day control over the business. And of course, that gives top management an opportunity to override the internal control system because of their power. And of course, as we know, in light of various frauds that have occurred in the corporate world, from time to time, that does in fact happen. And typically, fraud is occurring because top management has the opportunity to gain economically, typically through a higher share price by manipulating profit, right? Taking steps to make profit higher. If profit is higher, they could argue they should get more bonuses. If profit is higher, the share price is going up. So as they get more stock options, that means that they're gathering wealth in that manner as well. With respect to speaking specifically around long-term liabilities and shareholder equity, as the PowerPoint states, as fictitious liabilities may be created to misdirect cash into the hands of an officer. So this is typically one way that funds can be moved outside of a company is by setting up a false supplier, right? Again, this would be a case where management can override internal control, have a supplier set up to the business, and then start creating false liabilities for purchases that don't exist, and actually funneling payments out to themselves through some type of intermediary. What we want to do, of course, is ensure that to the extent we can in an internal control system that these types of things cannot occur. Management, of course, has to, at the end of the audit, sign a letter of representation, which does say that the financial statements do present fairly. So from a financial auditor perspective, you do have to consider, though, whether fraud has occurred in the accounts. In particular, income tax evasion is another potential problem to the extent that top management can manipulate income, put income in certain countries where perhaps tax rates are low or tax rates don't exist because there are no taxes. Creating fictitious transactions to move profit into these low tax rate or no tax rate countries These types of transactions may in fact perhaps be illegal. They may be challenged by tax authorities in different countries, with the result that future tax liabilities will actually increase. As well, if debt in the balance sheet is not recorded, for example, that may put the company onside in terms of debt covenants that they have with people who have loaned money to the company. But in fact, if liabilities are understated, the actual loan covenants, in fact, may be breached, and this may not be discovered for a long period of time. So manipulation of financial data can have many negative effects on the company. And typically, though, what happens is when top management commits a fraud, they're around for a few years at the senior level, and then they leave the company. And sometimes they leave the company before things sort of go bad. And probably a recent example of this would be General Electric. I mean, the former CEO, Jeffrey Immelt, he was there for many, many years. And there wasn't a fraud going on there, at least that we know of, but there were many bad decisions that he made. And it wasn't too long after he left as CEO that General Electric started having great difficulties. Right, and their share price fell from $50 or $60 a share down to around $3 or $4 a share. It's come back now with a new CEO, but that company had really poor management at the top, yet he made millions and millions of dollars himself. So you have to wonder, how were the financial statements essentially manipulated in that way to hide the problems that that company had. I suspect myself there must have been some fraud going on there. Again, nothing's become public yet. It doesn't mean that it's not being investigated, but certainly there are some very questionable management decisions made in that type of situation. One of the problems with respect to fraud is that in order to convict a member of management or anyone actually on a fraud charge, you have to be able to prove intent. And so how can you prove intent? Right? Intent is essentially a state of mind that you actually intended to defraud people out of money or other types of assets. From an auditor perspective, we try to watch out for fraud by having what we call professional skepticism. Okay, and so in the conduct of an audit, when we talk about professional skepticism, so this is something we talked about way back at the beginning of the course, talking about the fact that auditors should be using their audit skills and keeping their eyes open, right, as they conduct their audit. So this PowerPoint states that the auditor should, if they have professional skepticism, be aware of factors that could increase the risk of misstatement. Okay, so for example, the power structure in an organization. Can the CEO have the ability or opportunity to override internal control, right? Be sensitive to information or evidence that you gather during the course of the audit that might point towards whether management is acting in good faith or not. And we might have information that conflicts, and we have information which conflicts with each other. It's an indication that maybe there's something wrong, right, that's going on. Normally, you would think information is a consistent flow, sort of moves in one direction. But if you have information that seems to be moving in different directions, maybe it's what we call a red flag, right? And so we may be able to point to different circumstances that arise in the business that are, in essence, red flags or warning signs that the risk of fraud has actually something's occurred, and that we should perhaps alter our procedures as auditors due to the potential for fraud. Part of the problem in detecting fraud, of course, is that two or more parties may actually act to conceal the fraud, right? And so that is very difficult if two or more people are intentionally hiding fraud, because very often that means they're altering documents, right? If auditors are looking at documents, they may not realize that they've been altered, or in fact they're not real documents, right? They're just copies made up, right? False documents that had been maybe photoshopped and things such as this. So technology today as well creates opportunity for fraud. If an auditor does find fraud, though, with respect to transactions that have occurred at a client, typically what you have to do is first report the fraud to one level higher than the fraud occurred. Okay, so if, for example, the CEO and the CFO are involved in fraud, you have to go one level higher. Of course, there is only one level higher, and that would be the audit committee and or perhaps the entire board of directors. But if fraud occurred at a lower level of management, then you go to the next highest level, right? So let's say for example, the controller in the company committed a fraud, then you would talk to the CFO, right, who the controller reports to. So always go one level higher in management first. Then if top management's involved, you go to the board. If you unfortunately discover that top management and the board are involved in fraud, then is being suggested in this PowerPoint, you're going to have to seek legal counsel because you have a contract with your audit client to complete the audit. But of course, your contract is signed on the basis that top management and the board are not committing fraud, are not hiding information from you. And so if you discover there is a fraud going on and top management and the board hasn't told you about it, then of course it sounds like there's been a breach of the contract. And then you're going to need legal advice in terms of how to manage yourself through that breach of contract that perhaps your client has conducted. Okay. With respect to actual investment securities themselves, of course, one of the controls we said that should be in place is actual custody, right? So if you have securities on site at your office, they should be, of course, locked away in a vault and things like this. The vault itself should be locked. Only a small number of people should know the combination to get into the vault. Other people should not have access to the vault at all. Should not know the code to get into the vault. So that, again, physical control over securities is very important to prevent securities from being stolen as well. Okay. The last point, it says cash payments from investments may not fit the cash control system due to size and the unusual nature of the payments. So what that's referring to, if you sold a large investment, right, and you have a large amount of cash coming in all at once, the receipt of that much cash may, in effect, not be a normal transaction where the company perhaps has smaller sales transactions and then sells a major investment. Okay, so let's say the average sale transaction is $100, but you sell one of your major investments and you have $100 million, right, coming into the company. Well, your internal control system over cash might not be used to dealing with that much of a cash infusion all at once, right? So there could be a breakdown of the internal control system simply because of the size and the nature of the payments that are actually being received. Okay, so large and unusual transactions are things you also have to watch out for as an auditor, because the internal control system essentially is meant to is designed to handle transactions which are of a recurring nature. That's why we have accounting systems such as revenue, receivable, receipts, right? Purchases, payable, payments. These are cycles handling smaller, typically high volume transactions. So there is higher risk around transactions which are irregular, but for larger dollar amounts. Okay, this particular PowerPoint is suggesting. Okay, in this last PowerPoint, we've talked about continuity schedules before. The idea here is with respect to investments, you can look at what was my investment balance at the beginning of the year, how many investments did I purchase, what did I sell, what's my investment balance at the end of the year. You can track that movement or continuity of the account and compare that to prior years, right, in terms of how those accounts have moved. If something looks unusual, of course, then you can assess the risk of a misstatement and follow up further. Okay, and that's what they're talking about in the last bullet point. The financial statement relationships in the continuity schedule can be used to analyze or create a vision about what could a potential misstatement be. Okay, so if something looks unusual when you put the continuity schedule together, when you compare this year's maybe to last year's or the last 2 years, it gives you ammunition to look further, right? It's sort of a warning sign that maybe something is wrong. In and of itself, the continuity schedule will not tell you what actually happened, but it's just essentially like an arrow. It points you in a direction. And so much of an audit process is about gathering audit evidence that points you in a direction, and you have to go further to gather more evidence to find out what's actually occurred, right, around a certain transaction. Okay. All right. So that finishes off chapter 14. So we'll move into chapter 15 now. And, I'll just switch over the PowerPoints here. Okay. So as we see here, essentially what we've done at this point is completed our discussion around the various cycles and discussions around internal control in a business. And I'm sure as you've gathered from our discussion around internal control, it takes a long time to actually become proficient, right, at the understanding of internal control in a business, because, as I've mentioned before, businesses have hundreds of internal controls, maybe even thousands of internal controls in a very large multinational company. And of course, the system is there. You mentioned right at the start of the course, why do we have an internal control system? To promote effectiveness, right? Help the company achieve its goals, to promote efficiency, right? And to help the company follow the laws and regulations of the lands in which it operates, right? All of these good things is what an internal control system is meant to do. But as we've discussed the various accounting systems, things can go wrong, right? Frauds can occur, errors can be made, systems are created by human people. All we have to do today is look at the IT systems in general, and we know that because information systems are created by people, they can be hacked into, right? Anything man-made can be destroyed, and unfortunately, that's what people try to do from time to time. Okay, so now we want to proceed. So essentially setting the stage here a little bit for you is, let's assume that our audit client has a December 31st year end, okay? We'll assume we're doing the year end for December 31st, 2020. So normally what would have happened, right? The audit planning took place probably back in the July-August timeframe. The auditors, assuming that they're relying on internal control, probably have been out of the client's premises at least once before the end of the year, typically for 1 week or 2 weeks. So that may have occurred in September and October. The auditors may have decided to, because the internal control system is so strong, that they're going to confirm accounts receivable balances and accounts payable balances 3 months before the end of the year. So that would be September 30th. They would confirm, send out confirmations that we've discussed before to customers of the business, to suppliers of the business, to try and ensure that the balances at September 30th are accurate and reliable. And then we've mentioned the auditors will roll forward, right, those confirmed balances typically from September 30th to the end of the year. And I use that phrase roll forward. So what I'm referring to there, for example, if the accounts receivable balance at the end of September was $20 million, then to roll that forward, you would do a continuity schedule, right? You would add in October sales, deduct October cash receipts. That would give you your October 31 balance. Then when you would add in your November sales, deduct your November cash receipts. That gives you your November 30th balance for accounts receivable. Add in your December sales minus your December cash receipts. That would give you your December 31st, 2020 year-end balance. And so that roll forward schedule, again, typically you would compare that, right, to at least last year, sometimes the last 2 years, to look for trends, right? Unusual trends in the numbers that need additional follow-up and explanation. So Auditors do, again, a lot of that work before the end of the year. And then normally, depending on the size of the client and how fast they can get ready for the auditors to come in, the auditors will make their final year-end visit. And so this particular chapter deals with that process, right? What are the auditors doing when they come in at the end of the year? So it's a very busy time, of course, for audit firms. Typically the December to April period, so that 5-month period, audit firms make about 75% of their revenue in that 5-month period. Okay, so they're very, very busy. And of course, that means their clients and staff working at these companies are very busy as well. Okay, so again, talking about just introducing you in this PowerPoint to the year-end process. Says this chapter covers the completion of the financial statement audit. Audit of what it calls the nominal or flow accounts cannot be completed until year-end. So the nominal accounts, they're just talking about the accounts which have small balances in them, right? We don't spend a lot of time on those accounts from an audit perspective because the amounts are small. There's no way the amounts could be material. So essentially they're subject just to a year-end review, make sure the balances are very small compared to prior years, right? Basically analytical review. The next point mentions audit of several year-end balances, says has been covered in auditing the accounting cycles. So the year-end balances I'm referring to are the accounts receivable. For example, I just mentioned the accounts payable, right? And so forth. The last point, some procedures are particular to year-end. And so some procedures just cannot be done before the year-end, right? You actually have to get past the year-end date. And one thing that we have discussed, we mentioned bank accounts are always audited 100%. So obviously you cannot audit the December 31st, 2020 bank account balance until you get to that point in time. Right? So there are certain procedures that must be done at the end of the year on the numbers, but then as being suggested here, subsequent events, looking for contingent liabilities at the year end, looking at financial statement presentation and the disclosures made in the financial statements, that all has to do about the final process, right? In terms of actually putting the financial statements together, the numbers, and also putting the financial statement notes together, right? As required under IFRS. So that's a huge effort, right? That happens right at the end of the year. Now, of course, in a recurring audit, you have the benefit of the prior year financial statements. So you use the prior year financial statements essentially as a foundation on which to build the current year financial statements. There will be changes, right? But in most cases, the changes are not that dramatic. Sometimes there are dramatic changes when IFRS might change significantly. New standards come in on a constant basis, basically, but not all new standards impact all companies. So you may go several years actually, and the financial statements year to year sort of look about the same in terms of the financial statement notes, but then you may have a significant change that occurs, right? Or even the audit report itself, right? In earlier chapters, we talked about the audit report and the format of the audit report and how much has changed, right, over a long period of time. We went from a 2-paragraph audit report to a multi-paragraph audit report, right? Today we have something called key audit matters, right? We have other matter paragraphs, right? So we have a lot of other things in our audit report today that, 30 years ago, we never had. Hopefully it makes the audit report better. But all of these things, especially the last point discussed here, contingencies, subsequent events, we can't do those procedures until the end of the year. This PowerPoint is talking about the revenue and expense accounts, okay, in a set of financial statements. Keep in mind, our year end for our client we're discussing is December 31, 2020. So last year we audited the balance sheet, right, for December 31, 2019. This year we've audited the balance sheet for December 31, 2020. There are some auditors, accountants that argue, well, the income statement just sort of falls out of the two balance sheets, right? It's what happens in between the two balance sheets, okay? So that's kind of an interesting perspective. I tend to look at it myself and say that the balance sheet that ends this year falls out of the income statement transactions that occur throughout the year, right? So I have a little different perspective on that. But again, when you read the PowerPoints here, you just need to keep in the back of your mind that people have different perspectives in terms of how numbers are actually put together in financial statements and how they result. So the first point says revenue accounts represent all the valid transactions recorded correctly in the proper amount, in the proper account, and in the proper period. Right? So we have determined through our testing of the revenue receivable receipt cycle that the revenue transactions are valid. Right? They actually occurred. That they were recorded in the proper accounts. Okay, so that sales were recorded in the sales account, not in another account. The amounts are recorded and they're in the proper period. So typically we've tested cutoff, right? Remember we talked about cutoff and said that we have to ensure that December's revenue is recorded in December, not in the following January. We have to make sure that the January revenue for 2021 is not recorded in December of 2020. Right? You have to get the numbers in the right period. The next point, accounting for consignment and cost of goods sold with rights of return is in conformity with accounting principles. So what they're talking about here, consignments, most businesses don't have inventory on consignment. But if a company is holding inventory that's on consignment, it's not inventory, right? They don't own the inventory, so it should be segregated. And so we would have picked that up during our audit of the purchase payable payment cycle. And then cost of goods sold is said with rights of return. That means that when we sold items, right, if there's a return privilege that the customer has, that we've properly accounted for the estimated returns, okay, on the sales. And in fact, with respect to cost of goods sold, for items that have been returned, that we've put the items back into inventory and reduced cost of goods sold. The third point, expense accounts represent valid transactions, right? And they are recorded again in the proper account. So cost of goods sold is recorded in cost of goods sold. Insurance expense is recorded in insurance expense, etc. The amount that is recorded is correct because we are relying on controls, right, to typically record the proper amounts. And we have tested cutoff so that we know January 2021 expenses are not recorded in December of 2020, and December 2020 expenses are not recorded in January of 2021. Right? Everything's in the right year. And then revenues, expenses, cost of goods sold, and extraordinary, unusual, or infrequent transactions are properly classified and disclosed. Revenue, expenses, cost of goods sold, that's easy. But if we do have other infrequent transactions, or what we call extraordinary items, they do have to be separately disclosed in the financial statements. So an extraordinary item is something which is not expected to reoccur on an annual basis, right? So that is always disclosed separately in the financial statements. Okay. Now, what types of things are the auditors doing at the end of the year? So in this PowerPoint, you see it's called the essentials of completing an audit. So we'll talk a little bit about each of these points. The first one says auditors must analyze the income statement, look at the categories and revenues, expenses, and ask themselves, are they fairly presented? Well, again, we have determined through our test of controls, right, expenses and revenues should be properly reported. We've tested the accounts that items are recorded in. We've tested the amounts, so everything should be okay. But we do that one last final review, right? How do the numbers compare this year to last year? And can we explain any differences that have occurred, okay? When we look at the numbers, we're going to make a decision. Are there any additional substantive procedures that we need to complete? Right? So maybe one of these small expense or small revenue accounts this year happen to be a lot larger, right, than for some reason, and we're not sure why. Or we may have to do additional tests of detail on that expense account or revenue account to make sure that we understand the nature of the transactions that occurred this year, and that in fact there hasn't been an error, right? So again, just from our overall analytical review process, And again, this is discussed a bit later in these PowerPoints, but that, again, knowledge of business that we have discussed, right, many times throughout the course is so critical in looking at the final numbers and just asking ourselves, do they appear to be correct? Of course, we have to review the financial statements themselves, the cash flow statement, make sure that that's properly presented, the statement of changes in shareholder equity, and of course, the many notes that appear in the notes to the financial statements. There's a lot of time spent putting the notes together in the financial statements. For most companies, for most public companies, right, the actual financial statements, the numbers are only 4 or 5 pages, right? The statement of financial position takes 1 page. The statement of comprehensive income takes 1 page, right? So there's 4 or 5 pages. But then the notes of the financial statements in many of these public companies take anywhere from usually from 60 up to perhaps as many as 100 pages, right, of financial statement notes. So there's a lot of additional information that's given about the numbers, right, and about the company and what's going on. And of course, it's critical to read all the information in order to ensure we have a proper understanding of what's happening in the business. We've mentioned before auditor concern around unrecorded liabilities. So in order to determine whether there are unrecorded liabilities, auditors always perform what is called a search for unrecorded liabilities. Okay, search for unrecorded liabilities. And there is a later PowerPoint that deals with this. We'll talk about some of the procedures that auditors actually perform. It tends to be a favorite question of mine on the final exam. Okay, search for unrecorded liabilities, because keep in mind, if a liability is not recorded, the other side of the journal entry is very often debit expense, right? So this is why auditors are so concerned about unrecorded liabilities, is because if they exist, then the other side of the equation is usually debit expense, credit liability, and that means profit is overstated if we haven't recorded all the liabilities. We have to, as we look for additional liabilities, normally are concerned about contingencies, contingent liabilities. We have to look at those and evaluate those. Commitments in terms of lease obligations typically, but also pension plan liabilities. And we have to look and make sure that we've properly done all the proper accounting, all the proper disclosure around these liability accounts exists. And then subsequent events, where it just talks about the auditors are responsible from the balance sheet date, December 31, 2020, until the financial statements are approved by the board of directors. So let's say the board of directors approves the financial statements on February 28th, 2021. The auditors are responsible for determining any material effect on the numbers during that 2-month period. So they have to do what's called a subsequent events review to ensure that no transactions or other events have occurred after the end of the year that could affect their audit report or the year-end financial statements. In addition, auditors always require a letter of representations from management, right? And I always tell people, from the audit firm side, you never release a financial statement until you have that signed letter from management, because that's the letter in which management says the financial statements do present fairly, right? So they're going on the hook, signing the letter and saying, yep, the numbers are okay. If management doesn't give you that letter, right, as the auditors, then it's an indication there's possibly something wrong. Some information is being held back. Whenever I've experienced that in my own career in trying to get representation letters from management, that's typically what happened. Most of the time, it's not a problem. They sign the letter and they give it to you right away. However, sometimes they hold it back, right? So you know there's something going on. Maybe there's been a large income tax reassessment. Maybe there's been a lawsuit started. Right? Not getting that letter is an indication, it's a red flag, right, that auditors have to be concerned about. As members of management, you may be involved, right, in interacting with auditors on some of these subsequent events that might occur. In addition, as part of the quality control, right, the companies have, so we've talked about the quality control processes required in the accounting profession, the senior audit team members, so we have the people in the field Right? We call that the audit field team, actually doing the audit. So these are people learning how to do audits. There's an audit senior, so normally someone who has about 3 years of audit experience on that client. There's an audit manager, right, involved. And audit managers normally have about 5 or 6 years of experience. Then there's an audit senior manager, usually someone who's 8 or 9 years into their career, someone's trying to become a partner. And then, of course, you have the audit partner. Okay, so that's sort of the structure. Well, as audit work is completed, it's reviewed at these various levels. Okay, so that whole review process has to occur as well as part of the year-end audit process completion. Okay, Exhibit 15-1 is referred to here, and that's on page 672 in the text. Okay, and so there's a essentially a diagram there that shows you how the audit is completed, and it contains everything that we've talked about so far, and a number of items that we still have to talk to as we go through the process. But as we go through the PowerPoints, you might want to just sort of keep your finger in the page, or even make a copy of that page so you can reference it as you're reviewing the PowerPoints in this chapter, or even as you're preparing perhaps for the final exam. Okay, completing the audit of revenues and expenses. This is discussed on page 673 in the textbook. It says a number of the revenue and related topics were audited whole and part with the other account groups. So what they're talking about there is the cycles, right, that we've gone through, chapter 11, 12, 13, 14. So many, right, and usually most of the revenue and expense accounts have been covered off somewhere in the audit of those particular accounts. Because auditors do a lot of referencing in their file as to which accounts have been audited, it will become evident through a review of their files which accounts have not been audited, right? So when you determine which ones have not been audited, normally those will be the smaller accounts where you don't spend a lot of time on. And as I've mentioned, usually you use analytical procedures, and that's what why they're talking about it here in this PowerPoint. It says analytical procedures can be used as substantive procedures to compare the revenue accounts and amounts with prior year data and with multiple year trends to look for unusual fluctuations. So this is the analytical review that happens at the end of the year on the smaller balances, right? Excuse me. On small balances where we say there's low risk, we're not going to spend much time. We're just going to do a cursory review. So there might be, for example, a miscellaneous revenue account that has, $2,000 in it. And it looks last year there was $1,800. The year before there was $2,100. So the number looks very reasonable, right, compared to the prior years. Now, if in this year miscellaneous revenue is $2 million, right, whereas last year it was $1,000 and the year before that $2,100, then we need to do some additional audit work, right, because the number is sort of jumping out at us on the page. So our analytical review will say, oh, maybe we missed something, right? So maybe there was a asset disposed of and there's a large gain, right, that's recorded in that miscellaneous revenue account. So your analytical review process, just comparing these miscellaneous accounts at the end of the year, is what auditors do, right? So every account is audited, but it's a matter of how much audit effort is spent on each account. So smaller accounts, because they have small risk, there's not much time spent on them, right? You spend time on the high risk accounts because typically that's where the material errors can occur. But the analytical review process is so critical at the end of the audit in order to catch accounts that might contain unusual amounts, right, compared to prior years. Now, in order to catch that, what do you have to have? Usually a good knowledge of business, right? If you understand the client's business, you can detect numbers that look unusual, right? And then, of course, you can follow those up to determine what types of other audit evidence you should be able to gather. This PowerPoint, number 10, just discloses typically how many of the revenue accounts and other issues have been addressed during the audit of the actual accounting cycles, right? So the various revenues that you see listed here on the left-hand side. On the right-hand side, you see the various asset accounts that they relate to, right? So if we take, of course, sales being the most common cycle, that, of course, relates to the receivable account, right, on of the balance sheet. And, of course, we could also put in the bank account here as well, right, being another account, which is part of that related group. And then similarly, with respect to the expenses, whoops, sorry, let's go back here. With respect to the expenses that occur on the income statement, many of those, of course, are audited as part of this cycle, right? The cost of goods sold and purchases, we mentioned, of course, relates to inventory. And of course, we could also put in accounts payable here, right, as a related group. So that's why, from an audit perspective, we audit things as a cycle. Right? The inventory balance is the part of the purchase cycle, isn't it? The accounts payable balance is part of the purchase cycle, because when we buy things, we debit purchase, credit accounts payable. So to be efficient, we always study things and do our work in terms of these cycles. And that covers off the large numbers, right? The accounts receivable number and the sales, the accounts payable number and the purchases. Of course, purchases relates to the cost of goods sold calculation. We've already mentioned that auditors normally count inventory at the end of the year, right, in that final step of verifying cost of goods sold for the year. Okay, this PowerPoint on expenses, this is discussed on page 675 in the text. It says some minor expense accounts, like office supplies or utilities expense, will not be covered until the end of the audit. Why? Because those accounts are small, right? They're immaterial. So we're going to simply rely on what I've already mentioned, the analytical procedures. Right? We'll look at the expenses maybe as a percentage of revenue. We'll compare them to last year or the last 2 years to say and ask ourselves, do they appear reasonable? Right? And if they appear reasonable based on our analytical review, we accept them, right? Because we feel, based on that level of work, that there could not be a material error in those various accounts. You may also, I've already mentioned, have miscellaneous accounts, right? So miscellaneous income, miscellaneous expense. Again, you're doing the same type of thing, just comparing those balances this year to last year. Do they look reasonable on the surface? If so, you don't do any more work. Now, something you always watch out for would be accounts with debit balances, right, where they shouldn't be debit balances. So if you had, for example, a revenue account that had a debit balance in it, you might want to have a look at that, right? Because revenue accounts should not have debit balances. Now, of course, sales returns, right, sales discounts, those are debit balances. But what I'm referring to is if you have a regular sales account, right? So let's say you have 12 stores and you keep track of sales by store, but in one of the stores, the sales is a debit rather than being a credit. Well, you should investigate what's going on there, right? Because sales accounts should not have debit balances in them. Similarly, if you have expense accounts that have credit balances in them, right? Expense accounts should have debit balances, not credit. So you're just looking for red flags, right, when you're doing this analysis, analytically analyzing information at the end of the year to identify what looks unusual. In addition, depending on the tax rules in the country where you're actually doing your work, you have to consider certain tax-related numbers. So, for example, in Canada, travel and entertainment expenses, you can only deduct 1/2 of those expenses for income tax purposes, right? And so we isolate certain accounts which have tax importance to them. Charitable donations, okay? They are affected in certain tax calculations as well under the Canadian tax rules. So, of course, you're not responsible for Canadian tax rules, but just as a general comment, so you're aware, some balances do have a tax impact. And so auditors, as they do their work, are considering those balances and isolating information with respect to those balances as they do their audit work. So we've mentioned analytical procedures quite a bit already, and in fact, we talked about analytical procedures much earlier in the course. We said that an auditor is required to perform analytical procedures at the beginning of the audit as part of the audit planning, right, in order to ensure that you properly assess the risk uh, of the accounts that you're looking at. And then auditors must also do analytical procedures at the end of the audit. And again, it's to ensure that you can explain, right, the various movements in the accounts. Why have receivables gone up 20%? Why has accounts payable gone up 10%? Right? Why is inventory up 5%? Why are capital assets up 10%? Auditors should be able to look at those balances and have the answers as to why the numbers have changed. Okay, so we do analytical procedures at the beginning as part of the planning process. We do them at the end, sort of as a catch-all, to make sure that we have covered off all the material balances and covered off in a cursory way all the smaller balances to make sure that they appear reasonable. Okay, and then in between, right, while we're actually conducting the audit, we're sort of doing analytical procedures in our mind, right? Because as we gather information, we're saying, is this information consistent with the planning work I did, right, at the beginning of the audit? And when we move towards the end of the audit, we're still asking ourselves, is this information consistent, right, with what I planned, what I'm discovering? So we're actually doing analytical procedures mentally, right, as we gather our information during the course of the audit. We don't document it as analytical procedures during the course of the audit. Right? We do it at the beginning, we do it at the end, we do document those procedures, but throughout the course of the audit, we don't document everything as analytical procedures, although we're thinking that way. Okay, so it's more of a mental process, right, that we're following as we do the work. Again, this account is talking about reviewing over these miscellaneous accounts or accounts which are normally credit that have debits in them, etc. It says identify each important transaction, determine whether amounts are properly classified. Again, if you saw a miscellaneous revenue that had $1 million in it, whereas normally it's $1,000, there's probably a classification problem. Right? There's something recorded in there, that account, that should not be there. And then we've already mentioned today as well, any miscellaneous accounts, right, could have accounting errors. But again, if there's accounting errors in the accounts, they're going to be larger compared to prior years. So you can go and review the content of that account, look at the test of detail, right, to satisfy yourselves. Do I need more information? Maybe I have to make a journal entry to reclassify, right, some of the information that is recorded improperly in one of the general ledger accounts. Throughout the course of the audit, auditors may be faced with what we call unusual transactions. So this is discussed on page 679 in the text. So unusual transactions, what do we do with those? So in the PowerPoint, it says significant, spelling mistake there, it says UDIT, UDIT, should be AUDIT. Significant audit evidence and reporting problems can arise where management has created complicated transactions to manufacture earnings artificially, right? So how can management manufacture earnings? Well, there's actually a number of ways, but one of the ways would be to essentially have transactions between related parties, right? So transactions between a parent company and subsidiary companies, right, that might affect revenues or expenses. In addition, with respect to revenue transactions, management might actually combine a number of transactions into one transaction. So we have the concept of a bundled sale. Okay, so the IFRS standards were changed just about a year ago to deal with the issue of bundled sales, right? So for example, when you sell let's say you sell an iPad, right? And with the iPad you get a 3-year warranty on the iPad. Well, the iPad itself maybe is worth a certain amount of money. Let's say you spend $2,000. Well, the iPad itself might be $1,500 and the warranty is $500. So when the sale is recorded, before the change in the IFRS standard, you would just debit cash $2,000, credit sales $2,000. However, the problem is the warranty goes for 3 years. So really, the portion of the revenue, the $500, should be amortized over 3 years, not all taken into revenue in 1 year. So this was a measurement problem, right, in the amount of revenue. So the IFRS standard now around revenue has said you have to break down sales where bundled sales are occurring and account separately for each of the components, right? So you have to, when you're looking at sales transactions in a company, part of what you have to ask is the sale really a bundled sale where the accounting should be broken down and conducted in more detail, right? So that we have the revenue being recorded in the proper period. Okay. So auditors are always concerned about unusual transactions. Again, on the revenue side, it might be a revenue created through a transaction with a related party, a subsidiary, a parent company, a top member of management, right? A relative of a top member of management. So we're always have our eyes open, right? Looking for unusual transactions that are affecting the financial results in the business. And of course, when we find those unusual transactions, we have to investigate those, right, to make sure that we properly understand them and that the audit work that's required on those balances has been properly performed. I've already alluded to this today, but with respect to the sequencing of audit work, when it actually gets done, this is discussed on page 681 in the text. I've already mentioned, right, again, assuming that our client had a December 31, 2020 year end, the auditor does their visit before the end of the year, right? For a December year end, very often, September, October, sometimes earlier, even in the summer, but depends on the size of the client. Sometimes they may have an interim visit 2 times before the end of the year. Okay, so that's also possible. On very large multinational clients, the auditors will be in there 2 times a year before the year end, and then plus the year end. So they're in there a total of 3 times. Okay, and during that pre-year end visit, of course, they're auditing internal control, right? Testing the controls to make sure that they can rely on them. And then sometimes they're also doing their substantive procedures before the end of the year. So, for example, what I referred to earlier today, confirm accounts receivable at September 30th, right? Confirm accounts payable at September 30th, where internal control is strong, right? And auditors can rely on the internal control processes to prevent, detect, and correct material errors in the October to December period. So a lot of work gets done before the end of the year in large companies because they do have strong internal control systems. And then the auditors come back right at the end of the year. So they have to complete their work on testing controls, right? So when they come back in January, they have to complete their control testing for October, November, December, of course, to make sure the controls worked in that period. They can't assume the controls are working. They have to actually test them. They complete their work on the year-end balances, so the continuity schedules that we've talked about before, rolling forward, right? The accounts receivable and accounts payable balances, where we confirmed the balances at a pre-year-end date. So, for example, it's September 30th, right, for accounts receivable, as I mentioned earlier today, roll forward that balance to the end of the year. Other balances where we have to actually complete audit work at the end of the year. So, for example, counting inventory, right? We have to have done that typically, of course, before we come back to do the year-end audit. So very typically on December 31st, right, the auditors are out at their clients actually counting the inventory. Now, when auditors come back to do their year-end work, at what point do they come back, right? If it's a December 31st year-end, are they always there in January? Well, for many clients that have strong internal control systems, the answer is yes. They do come back in January to do a lot of the procedures that we're talking about here, the year-end work. However, sometimes clients do not have strong internal control systems. Sometimes clients need more time to get ready for the auditors to come in because they have limited staff, okay? and unfortunately, in some clients, your accounting records are disastrous, right? They haven't been well maintained. So actually, how long will it take to complete the year-end work? Well, in a client with a strong internal control system, typically you can get done in several weeks. But for a client with a poor internal control system or poor accounting records, it can take months, right? When I first started auditing myself, I was working in Toronto at the time. And the very first audit that I was put on was a large real estate company based in Toronto. And but the accounting records for this company were disastrous. And the first year that I was put on this audit engagement, just to give you an idea, the bank accounts for this company had not been reconciled for 2 years. Okay, 2 years. Can you imagine not looking at your personal bank account for 2 years. Well, that's what was going on in this large company, the very large real estate business. And so happened it might be my first year on the audit. One of the senior auditors from our audit firm was hired by the client to come in and reconcile their bank accounts because they had lost control right over their bank accounts. So the senior auditor came in and was doing the work, spent a lot of time, right, trying to reconcile the bank account. And at the end of the day, discovered about $200,000 that he could not account for. So the client, rather than spending more time trying to figure it out, just wrote off the $200,000. Okay. And so the audit partner, of course, had signed the financial statements with the bank account not being reconciled on the assumption that the difference would not be material. And so it was not material, even though they wrote off the $200,000. But because of the level of risk involved, right, the client was getting bigger, growing. The audit partner decided, well, we can't keep signing off on the financial statements without the bank account reconciled. Because as we discussed in the course, all transactions flow through the bank account, right? Accounts receivable flow through the bank account. Accounts payable flow through the bank account. Payroll flows through the bank account. Finance and investment flows through the bank account. So when your bank account's not reconciled, you have high risk, right? That somewhere the numbers might be incorrect. So the risk just got high enough for the client and of course for the audit firm. The audit firm said you have to reconcile that bank account. And that's why, again, they hired the audit firm itself to come in and do the work. Okay? So that was quite the experience. But coming back to the timing, it was a December 31st year end, okay? So we didn't even go in to start the audit until March, right? So almost 3 months after the end of the year, and the audit didn't finish until May, right? So it went on for weeks and weeks and weeks, right? And sort of a little inside story, it was right in downtown Toronto. And, we were working very long hours at this audit client. So it was the very first audit that I worked on. And we worked 7 days a week. So we would meet at the audit client at 8 o'clock in the morning. And most nights, most days, we worked till, 11 o'clock at night. So from 8 in the morning to 11 o'clock at night. Then on the weekends, we also worked Saturday and Sunday, but normally we only worked 8 hours a day, right, on those days. And when we went like that, I still remember the number. I went 57 days straight without a day off, working on this client. So 2 months straight, basically, without a day off. So I was very, very tired, even though I was much younger, still very, very tired from doing all that work. And then, of course, when we're at the client, you can't go out for supper because you have to keep working, right? So we would just go out. There was Kentucky Fried Chicken very close to where the audit client was. So we had Kentucky Fried Chicken for most of that 2 month period for supper. And then sort of the joke in the family was that, after I had Kentucky Fried Chicken every night for almost 2 months, it was several years before I actually ate Kentucky Fried Chicken again, right? I was so tired of Kentucky Fried Chicken that I just couldn't stand to even look at the stores anymore, right, for quite a long period of time. But anyhow, that was a little inside family story. Okay, so let's go on from here. So year-end work doesn't always go too well, right? Okay, now I mentioned before, search for unrecorded liabilities. And this is discussed on page 681, okay? So auditors will perform various procedures in order to detect uh, liabilities which are not recorded, to detect contingent liabilities, to detect claims that have been made or may be made against the um, audit claim. And so with respect to contingencies, what types of things do auditors look for? What type of audit evidence do they try and discover? So the first one says auditors will inspect contracts and legal correspondence. Exactly. If you want to discover a problem that's going on at your audit client, look at the correspondence that they have with their lawyers, right? Ask for all the lawyers' files because they do keep them in large companies and review the correspondence, right? Remember, as an auditor, you're entitled to review anything that you want, right? Connected to the audit. So you can review the correspondence and discover, oh, here's somebody, it's a potential lawsuit or a lawsuit's been started, right? So you can make a little list for yourself. Here's all the things we have to deal with, right? Just by looking at the legal correspondence files, okay? Director minutes, okay? Board of directors, as I said, normally meet quarterly. Well, if a client's being sued or they're about to be sued, that will be recorded in the board of director minutes, right? So of course you want to get your hands on the minutes and make sure the client has given you all the minutes, right, of the board of director meetings, so you can determine, are there problems, right? Could be legal problems in terms of a lawsuit, could be a major tax reassessment coming, right? That's been discussed at the board level. In addition, auditors would send out letters to the lawyers, the external lawyers who act for their audit client, and will ask them to confirm the outstanding claims against their audit client as well as the possible claims. Okay, so this is where management must list the actual claims made against the company as well as the possible claims that they are aware of. Okay, and the auditors will send a copy of that letter to the legal firm, and the management asks their legal firm to respond directly to the auditors as to whether the claims and possible claims are properly presented. Also in that letter is management's estimate of the amount of claim. Okay. Now, with respect to that letter, management is allowed to have discussions, of course, with their legal counsel to ensure that they draft an appropriate and accurate letter. Okay. Because, of course, you don't want the lawyers writing back, oh, you forgot about this lawsuit or that lawsuit. They being management, can review that with their legal counsel before they send them the letter, right? And then legal counsel will just write back to the auditors, copy management, that yes, the claims and possible claims, as well as the assessment made by management of the potential liabilities, are correct. In addition to reviewing legal correspondence, normally you want to also review correspondence with the tax authorities, right, of the country in which your clients are operating. So if your client is operating in 10 different countries, you may have tax authorities in 10 different countries to look at correspondence files. And again, if there have been reassessments or there's threat of reassessment, you'll find out, right, by looking at those correspondence files. So that's a key source of information as well. In addition, we ask management for their letter of representation. Right? In the letter of representation, it says that management has disclosed any and all contingent liabilities and claims against the company. And of course, maybe sometimes management isn't signing that letter and giving it to you yet because they're concerned about whether they have to disclose certain information to you. And that's why I said a few minutes ago, from the audit firm side, you never release a financial statement without that letter. You always have to have that letter so that you ensure that management's made you aware of any and all problems. Another, it's not mentioned here in the PowerPoint, but another step that auditors do is they review the accounting records after the end of the year, right, to identify payments made, which are material and unusual, to look at cash received, that's significant and unusual, right? To identify perhaps additional items that need to be considered in the preparation of financial statements. Maybe, there was a large liability paid at the end of the year, after the end of the year, which was not accrued, right? Maybe there was an asset sold before year end that wasn't recorded until after the end of the year. And so by reviewing the accounting records after the end of the year, you can identify transactions that were improperly accounted for at the year end date. So that's another key source of information. Okay. Again, this whole process is referred to as the search for unrecorded liabilities, a major part of any audit process. There's a couple of PowerPoints here. Further talks about the auditor's correspondence with the legal counsel and the letter that management has to prepare to send to the lawyers. So we'll just spend a few minutes on this. It says auditors must communicate directly with the auditee's lawyer where there's a risk of material misstatement relating to litigation, which has been started or threatened, and claims made against the company. Right? So this is a must. Auditors must, talk to the lawyer for the company. This is part of generally accepted auditing standards. The procedures of obtaining a lawyer's letter, that's the letter that goes to the lawyer firm from management, right, through the auditor, and a letter of representation. It says, I defer to the last day of fieldwork. When you send the letter to the law firm, you want to make sure that you cover off all claims and possible claims up to the date of your report. So it's done very late in the audit process. And as well, the letter of representation normally is not actually obtained until after the financial statements have been obtained and reviewed and approved by the board of directors, right? So you do need this piece of information, but you don't get it until the financial statements are actually filed. And so these letter representations, it says here, are dated the last date of fieldwork. Actually, they're dated now. There's been a change in the audit standards. The letter representation is dated on the date that the financial statements are approved by the board of directors. Okay, because management, you have to make sure that management has disclosed everything to you up to that date, because that is the date that auditors are responsible for, up to the date that the financial statements are approved. The old rule was that they were responsible up to the last date of fieldwork. So that typically was at least 2 weeks before the financial statements were approved. But now the date's been shifted and said, no, auditors have to take responsibility for everything up to the actual date of the financial statement approval. Again, with respect to the letter that goes to the lawyer, it says auditors are required to make certain inquiries designed to elicit specific information. In the letter, so this is the letter that's going to the law firm, it says the client requests the attorney to provide the auditor with information about contingencies, litigation, claims, and assessments. Again, just the simple words are the lawyer has to make the auditor aware of any possible claims and claims which are not listed in the management letter to the law firm. Okay. Then it says other audit procedures will be designed to determine materially contingent liabilities. So again, that's reviewing, for example, the tax authority files, right? Reviewing the legal correspondence files, reviewing the board of director minutes, right? All these other sources of information auditors review to ensure that they have isolated and identified any opportunity for material error in the financial statements. Now, on occasion, we do have something called subsequent events. And these are events that occur after the balance sheet date. So in my example, after December 31, 2020. But when we find events that have occurred subsequent to the balance sheet date, you may have studied these in accounting courses. Subsequent events, we call them. They may affect the numbers in the financial statement, or subsequent events may affect the disclosure in the financial statements. Okay, so we have what's called a type 1 adjustment or a type 2 adjustment. So let's say the year ends December 31st and there's a fire, right, on January 5th before the financial statements are released and the inventory is destroyed. Is that a type 1 or a type 2 adjustment? That would be a type 2 adjustment, right? Because on December 31, the inventory actually existed. It was destroyed in a fire 5 days later. So at the balance sheet date, we do have the inventory, but we would disclose in the notes of the financial statements a subsequent event that on January 5th, there was a fire and all the inventory was destroyed, right? Because we want to make the reader aware of that, because the following year, when they see the financial statements, they're going to see loss due to fire, right? So if that occurred before the date that the financial statements are actually approved, we have to make sure the reader is aware of that, so they're not surprised, right, the following year when they see this loss. On the other hand, let's say a type 1 adjustment would be something that occurs after the end of the year, but which relates to the year end. So, for example, we may say on the year end date, December 31st, we had a customer in serious financial difficulty. Okay. And we established a large allowance for doubtful accounts. Then on January 5th, that customer went bankrupt and we're going to get $0. Well, the customer went bankrupt. If we were still carrying an account receivable balance, right? So let's say it was $1 million and we had set up an allowance of 600,000. So we still had 400,000 being carried as an account receivable. So after the year end, January 5th, our customer goes bankrupt. So we're not going to get any of that money, right? We're not going to get the remaining $400,000. In that case, that would be a type 1 adjustment. Okay, it's a transaction that occurred after the end of the year, but because the collectability of the receivable was in doubt at the year-end date, we would actually go back and record an additional bad debt expense of $400,000. Okay, so for subsequent events, the question is it an event which occurred which is going to affect the balance sheet, or is it an event which just has to be disclosed in the financial information? So as it says here in the PowerPoint, a type 1 adjustment, it's a subsequent event that provides new information about a financial condition existing at the balance sheet date. So that customer was in financial difficulty. They went bankrupt on January 5th. The new information is they went bankrupt, but the financial condition we knew did exist at the year-end date. So in case we do adjust the financial statements. And of course, here they talk about the possible loss of an account receivable, which was the example I used. And then, or litigation might be settled, right? So let's say a lawsuit had been started, was in process at the end of the year. We estimated our liability at year end at $2 million. On January 5th, we settled the claim for $2.5 million. So we paid more. That's additional evidence after the end of the year about the amount of a liability that existed at the year end. So that would be a type 1 adjustment as well. We would actually record the adjustment in the financial statements. The type 2 adjustment, right, is where, again, the numbers at the balance sheet are not affected. It's a subsequent event involving occurrences after the balance sheet date, but which do not require adjustment. No adjustment as the cause and the manifestation arise after the balance sheet date. Okay, so it's not reflective of something that was in existence at the balance sheet date. It's brand new. So let's talk about that receivable situation again. Okay, that account receivable, the customer we're talking about, was not in financial difficulty on December 31st. On January 5th, that customer's plant is totally destroyed and they go bankrupt, out of business. Is their account receivable written off at that point? No, right? Because at December 31st, the client was fine. On January 5th, they unfortunately had a disaster, right? So in that case, we would not adjust the year-end number, but we would have financial statement disclosure that subsequent to the year-end, a major customer went bankrupt and with a resulting loss after the year-end date of X dollars, right? But we would not actually adjust the financial statements for that loss because it's based on information that occurred after the end of the year that does not relate to a condition that existed at year end. Okay, so this, as you gather information about subsequent events, you have to make sure, of course, that the proper accounting is done in the proper period. Okay. In addition, when we're doing our subsequent subsequent events review. We're going to be typically checking the cutoff, right, to make sure transactions are recorded in the proper period. We're going to be reviewing valuation, right, of our balance sheet assets and liabilities to ensure that there's not new information coming to light that would affect the year-end values. Okay. Management's letter of representations, I've already mentioned. Of course, management's letter of representations, very important, right? It's a source of audit evidence. It does not, sometimes there's a misunderstanding about the letter of representations. The letter of representations, actually it's discussed on page 689 in the text. So you might want to have a look at that. There's a list of items on page 689 that go into a typical letter of representation. So it is audit evidence from the viewpoint that it's managed for its representation that everything is okay in the financial statements, the numbers and the notes. But that's a source of assurance for the auditors, but it does not relieve the auditors of their responsibility to fulfill the professional skills, right, and the work that they're supposed to be doing. And so it is essentially really meant as a red flag for the auditors, right? If management won't give you the letter saying that the financial statements present fairly, why not, right? There has to be some underlying reason why they're not doing that. In normal course, as I said, it's not an issue. You usually get it. But if you're not getting it, right, it's going to be a problem. Or if you're a member of management and you're not giving your auditors the letter of representation, they're going to be asking you, why not, right? Why don't I have it? They're going to be calling, right, and saying what's going on. So in the PowerPoint, it says the letter of representation, its primary purpose of that letter is to impress upon management its responsibilities for the financial statement. Remember at the start of the course, we said, well, when you have a engagement letter signed by management, that they do accept responsibility, right, for the financial statements. They're not the auditor's financial statements, they're the financial statements of management. The auditor should also ask direct questions to management about contingencies, litigation, claims, and assessments. As other examinations and procedures may lead the auditor to the discovery of contingencies. So we've already talked about that. But in the letter of representation, the auditor says, okay, to management, you have disclosed, right, all the contingencies to us. You have disclosed all the actual and possible litigation to us. You have disclosed to us all the claims and possible claims. You have disclosed, right, all the assessments or potential assessments that you're aware of. Again, have a look at the laundry list on page 689 of the type of representations that auditors ask management to make. Again, keep in mind the management letter of representation. It's a letter, right, which is given by top management to the auditors as a source of audit evidence. And then here's some additional information about the representation letter on this PowerPoint. So let's just read through this. It says the written representation is in the form of a letter. It's on the client's letterhead, yes, the company's letterhead. It's addressed to the auditor, of course, and is signed by the responsible officers, and dated as of the auditor's report. So because you want to tie down management, right, to the date that the board of directors approves the financial statements and say, up to that date, you've told us everything, right, that we have to be aware of. Okay. Normally who signs it, of course, CEO and CFO, okay, are two people that you want to sign it. So as members of management, if you're a CEO or CFO one day, you're going to be involved in this process, right? And the auditors are going to expect you to sign this letter, which is your representation that the financial statements are presented fairly. The next bullet point says, generally, it provides weak evidence. It's evidence, but is it high quality evidence? Well, we can perhaps talk about that. The authors say it's weak evidence, but to me, I think I would say it's better than weak because it is management's representation, right? And you can take some comfort in the fact that no one would sign something that they know is false. Because if you sign something and you know it's false, that's called fraud, right? And you can be sued and go to jail, and there'll be financial repercussions from that. So in my mind, I think it's not the strongest form of evidence, but it does carry some weight. And so the auditors are suggesting it's weak. What they really mean is, I think it's weak by itself, right? Because you always have to remember that management has the ability to commit some level of fraud, right? Because it's perhaps in their best interest, right, to promote their own economic well-being. So you always have to have that, idea in the back of your mind as to what's management's motivation. Okay. So by itself, yes, it would be weak evidence, but of course, it's better than nothing. And that's why it says here, in some cases, management's representations are the only evidence available. Right? So you may see a letter from a taxation authority that says we're coming in to look at a certain transaction. Well, the only people that might be able to give you information about that transaction is management. Right? And so there may be no other source of information that you can get access to. So in some cases, you are putting significant reliance on management's representations. But that's why, as the auditor, you have to be able to rely on what management is telling you. Right? And that's why on some occasions, auditors resign right from their audit engagement because they're saying, we've lost confidence in management. Right? We can't do this audit anymore because we can't trust management. Right? So if you have situations like this where you can't trust management, those are the types of audits you probably don't want as your audit firm, of course. Okay. All right. The next PowerPoint talks more about it. It says a number of items that must be included. The management has fulfilled its responsibility to prepare and present the financial statements in accordance with IFRS. Management has provided the auditor with all relevant information for the audit, as agreed to in the engagement letter. All transactions are recorded and are reflected in the financial statements. So again, this laundry list that you see in the PowerPoint, it's on page 689 in the text. So this, again, the management letter representations essentially is a catch-all. From an audit perspective, we say it's a catch-all. Anything and everything that we are concerned about as auditors, we put into the representation letter, right? Because we want management on the hook that everything is okay, right? If everything's not okay, we want management to be coming forward and telling us that there's a problem, okay? So the management letter, although it's weak evidence by itself, when you take that letter in combination with all the other audit evidence that you've got, I'll suggest that it confirms, right, the audit evidence that you've already gathered, that it is accurate and complete. So coming back to the audit report, right, I mentioned at the start of the course, do you have sufficient appropriate audit evidence? Right, so we've talked about all the cycles, etc., and subsequent event procedures and search for unrecorded procedures. Is all that evidence sufficient and appropriate? Here's management's representation saying the financial statements are okay. So if all your other evidence says the financial statements are okay, and management through their letter of representation says the financial statements are okay, hopefully the financial statements are okay. Right? Again, keep in mind, auditors audit to what degree of success? 95%. Something could go wrong, right? Auditors aren't perfect. Clients are not perfect, so there can be mistakes from time to time. Related party transactions, we've mentioned these earlier. Related party transactions, again, typically are higher risk transactions and are cases where potentially there could be fraud at risk. On the PowerPoint, it says auditors have a responsibility to obtain responsible assurance that related parties have been identified and disclosed in the financial statements. So one thing you do as an auditor at the start of the audit, you ask top management, please give me a list of related parties, because you have to have that list. So as you do your audit work, you can audit with your eyes open, right, as to what transactions are taking place with related parties. And that information has to be part of what the audit team has, right? Because there'll be many people looking at audit documents. You want everybody to be aware of who the related parties are. So what is a related party? It says related parties exist when one party has the ability to exercise direct or indirect control, joint control, or significant influence over the other party. And again, we obtain that list by asking management, but you also, of course, in review of your board of director minutes, or when you see transactions that appear to be unusual, you may be able to identify additional related parties that for one reason or another, management forgot to put on their list. Okay, so I've seen that happen. On occasion, management will forget to put a related party on the list, but it is pretty rare that that happens. And it's rare because top management knows how important it is that they identify all the related parties. Why? Because keep in mind, when they signed the engagement letter, they said they would give you all the audit evidence you need to complete your audit. So they know if they don't give you one or two of the related parties, they might be accused of not fulfilling what they said they would do, right? Not fulfilling their responsibility to fully disclose to you, for example, related parties. And then the problem is, if you think they intentionally withheld information on related parties, how does that affect the other audit work that you're going to do? Now, maybe you're going to have to expand, right, the audit work that you do in other areas. Why? Because you're questioning whether you can trust management or not. Right? So these can be difficult situations where management's not disclosing information to you that they should. Now, indications, the next PowerPoint says, of the existence of undisclosed related parties, things you could watch out for, abnormal terms of trade, right? So, oh, here's a customer. That customer doesn't have to pay until 120 days, whereas all the other customers have to pay in 30 days. Why does that customer get special treatment? Right? You'd have to get that question answered. Large and unusual transactions, of course, especially transactions that are occurring right close to the balance sheet date. Because as the year-end date comes, keep in mind, management's running out of time, right, to make year-end adjustments that they want to make to that balance sheet. So there could be, yes, large and unusual transactions before the balance sheet date with a related party, right, with the intention to manipulate the numbers. So again, that's something you look at very carefully, right, large transactions just before the balance sheet date. And then are there other transactions that have occurred that appear to lack a business reason, right, for the actual transaction? So again, that may be a transaction just undertaken to make the balance sheet appear better, right? Better ratios or other changes to the balance sheet, okay? So again, that's something that you always have to be concerned about, is where a transaction's done, but it doesn't appear there's a solid business reason for the transaction, right? It was just done to essentially make the balance sheet look better. And then the last PowerPoint just talks about the actual review process that goes on. This is discussed on page 693 in the text. Again, this is the internal review process that's completed at the end of the audit process by the audit firm. Okay, and of course, I've already mentioned the different tiers: the audit senior, the audit manager, the audit partner. Okay, so normally the detailed review is done by the audit senior and the audit manager, certainly by the senior manager. The audit partner normally does not review all the audit file in detail. He looks at the high risk areas, right? Because remember, it's the audit partner signing off, right? The firm name. So the audit partner, because of knowledge of business, will know where the high risk areas are. And they will look at the audit file in the high risk areas and ask questions about that typically. Of course, read the entire financial statement, make sure that the financial statements are in accordance with IFRS, etc. Deal with any problems, of course, in the audit report itself. In addition, as part of the review of financial statements for a public company, normally there is what's called a second partner review, sometimes called a regulatory partner review. So there's a second set of eyes that look at the financial statements, right, as a final check in the audit firm to ensure that the financial statements appear, right, to present fairly. And that second partner review, of course,
can challenge the first partner, the audit partner, in terms of the information that's in the financial statements, how the audit report is worded, the notes, etc. Again, the idea is simply to cover off liability for the professional audit firm in terms of the audit report that they're about to sign, right, to ensure that it meets all the professional and or possibly other legal standards that have to be met. Normally, you're just dealing with generally accepted auditing standards and ensuring that the accounting is proper. But in some regulated industries, such as banks, there may also be outside legislation that you have to conform to. Okay, so that gives you an idea about the completion of the audit process. Next day, I'll just talk about errors a little bit in terms of what happens with the handling of errors at the end of the audit process. Okay, and then we'll go forward from there. The next thing we're going to talk about a bit will be group audits. So that's where we conduct audits as part of a large corporate group. Maybe we'll have different audit firms involved. And we're also going to move into a discussion of engagements other than audit engagements, what we call review engagements and compilations, because you will also see those types of engagements done in large corporate environments, okay? Usually the audit is only done on the consolidated financial statements of the parent company. Maybe one or two of the subsidiaries also may be audited, okay, in case of, with respect to their own financial statements. But keep in mind, in a large consolidated company, you may have 50, 60, 70, 80 subsidiaries, right? These are huge companies. And usually the audit is just on the consolidated entity. The separate financial statements are normally the subject of either a review or what's called a compilation engagement, because financial statements for these other companies are also needed, usually for tax purposes, okay? But again, we'll talk more about that next week. But I do want to spend a few more minutes just finishing off the audit process. It's not discussed in the PowerPoints, but I do want to discuss what happens with errors found during the audit process, okay, and how those are dealt with. So we'll do that next day. Okay, thanks everyone. I hope you're all staying safe and in your environments. I know some of you are out of country, so again, continue to be safe. And questions, problems, let me know. I will be able, I think, to share with you next week about some information about the final exam, what the format will be, and I'll suggest a process to you to study and prepare for that. Okay, thanks everybody. Have a good day, and we'll see you next Monday. Take care.